Thanks for tuning in to Saal Mubarak. It's our annual appointment, wherein this year we speak to a marquee guest about how he or she thinks about the current market setup, the trends, and how does he or she feel about the next Samvat. Our guest today is Mr. Ridham Desai. Needs no introduction. Ridham, thank you so much for joining us, and to you in advance, Shubh Dipavali and Saal Mubarak.
Yeah, well, same to you and to the viewers of BloombergQuint. A very, very happy Diwali and Saal Mubarak.
Thanks, Ridham. Do you think it will be a Mubarak Saal indeed? The cues are kind of starting to turn around. How do you feel about the setup?
So, Neeraj, I like to be optimistic. Okay, there's no point in being pessimistic. But it does seem like we're set up for a great year ahead. So the coming Samvat may just be a fantastic year. Let's say all the cards are lined up favorably. So let's see how the deck performs. But I would be optimistic going into the next year.
Why do you say so, Ridham? When you refer to all the cards being decked up, what do you mean? Can you elaborate a bit?
Yeah, so Neeraj, you see, the pandemic basically pushed the Western Hemisphere to respond in a manner which we have not seen in the history of the world in terms of stimulus. So we got coordinated stimulus from the government and the central bank. Plus, its size is just gigantic. It is multiple times bigger than what we got in response to the global financial crisis, which was an economic crisis. This wasn't one. This was an external agent that was hampering the economy, that crippled the economy, and to overcome that, the various governments across the world, especially in the developed world, responded in a fashion that we have not seen before. So two things about it. There was synchronicity between governments and central banks, and then there was a synchronicity across geographic borders. So from the US right to Japan, everybody acted. So all that stimulus is now sitting there. And as the pandemic wanes, this stimulus will find its way into the real economy. Mind you, it has already found its way into the stock market. It has found its way into gold prices. And it may even find its way into property. As usually this happens, when we come out of a recession, we get a liquidity boost, which then goes into financial assets and then into real assets and then into the real economy. So the markets are anticipating some recovery in the economy. I dare say that recovery is going to be better than what the market is currently pricing in, and therefore there is more upside to share prices. Now that's one part of it. That's what happens in the immediate future. I think this is also the start of a possible multi-year turn, potentially for emerging markets, which have had a terrible decade, and therefore for India, which has also had a terrible decade. And now on top of this, you lay what India is doing. The pandemic has clearly egged the government to do stuff that it would have ordinarily not done in such a hurry. So we have new farm laws, which to me, prima facie, appear like the 1991 moment for the industrial economy, to the agricultural economy. Then we have new labor laws. We have these manufacturing incentives. We have a host of government policy response which promises to lift growth in India as well. So it looks very bullish out there. Of course, share prices have gone up and gone up a lot. I think we're up more than 50% from the March lows. But I think they may have a lot more room to go before we are done and dusted with this bull market.
Okay, a couple of global questions before I come to local. Do you reckon that the EM uptick that you spoke about could happen even if the US markets or other Western markets, for whatever reason, go through a bout of underperformance, maybe due to tax raises, maybe due to rising COVID cases and sentiment starring there? Can that happen concurrently? And just a word on the currency as well. What if the dollar were to weaken? How would that shape up for us?
So, Neeraj, our base case view is from our US strategist, is that we are in in a big bull market. We're in a long-term bull market, which of course will have intervening corrections. Remember a while back we had the Nifty go down from circa 11,800 to 10,800. It was a swift, quick correction which brought down several share prices by between 10 and 30%. And we will keep getting those type of corrections. And maybe we get one now because the market has rallied significantly from 10,800 to 12,600 in India. And the SPX has done a similar big move. And going into the next 2 months, there may be some uncertainty about US policy and about how the US Senate gets elected. And maybe the markets take a little bit of a breather. That's always possible. But the undertone is, and just to quote my US strategist, Mike Wilson, is that he's a committed bull. So we have a bull market in the US. It's not our base case that the US stock market is going to falter. The second point that you raised is a more interesting aspect of this and how this could feed into emerging markets if it does, which is that if the dollar depreciates, that will be godsend for emerging markets. Remember the period between 2003 and 2008, or more precisely 2004 and 2008, was a depreciating DXY period. And what a depreciating DXY does is three things. It allows emerging markets to run policy without fearing errors in policy. It causes accumulation of foreign exchange reserves. You're seeing signs of that in India already. What that means is that the central bank is busy buying US dollars because it doesn't want, it has to keep intervening in the currency markets because it doesn't want major appreciation of the currency. And as a consequence, domestic liquidity tends to be very strong. And the third thing is that international managers sitting in the US, as a consequence of a falling dollar, start looking to buy assets abroad. And emerging markets is one place that they go to. So it actually feeds extremely well into an EM bull story if that were to happen.
Okay, one final question again on the global front, Ridham. One can keep on looking at risks and go about the investment process, or one can keep on looking at what the upsides could be because of various reasons and then do this investment. My question to you is only this: the people who are looking at risks are, amongst other things, talking about possibilities of inflation coming back globally, feeding into crop prices, because there are a lot of people who say that asset prices have gotten inflated, but the real product prices haven't, and at some point of time they might bring back inflation and therefore rates, and therefore that could be negative equities, etc. Are you looking at, I'm sure you're looking at it, but are you paying more attention to those risks, or are you paying, in your wisdom, more attention to the upsides that could possibly come in because of this EM super cycle of sorts that you spoke about?
No, not EM super cycle, but yeah, I think both, Neeraj. We have been calling for an inflation upsurge in the US now for a while. I think the call was made way back in May. So the seeds have been sown for a shift in the inflation dynamic. So how the inflation dynamic plays out is, first you go into reflation, which is very good for financial assets. And then eventually you get inflation, and there is an accompanying policy mistake that the Fed makes, which is that it fails to see the coming inflation and therefore becomes lagged in its behavior. And that triggers a sell-off, and that's the peak of the bull market. So this is, into the next several quarters. We're yet to get to the point where we get inflation, but this is the base case forecast that our global economist, Chetan Iyer, is making, which is that there is a shift happening in inflation. This is not negative for equities. It's actually positive for equities, at least until we come to that moment where the Fed falls behind the curve. And mind you, the Fed is committed to this because, in the previous conference of the Fed said that it wants inflation. It is willing to err on the side of higher inflation because the US has been struggling to get inflation back. And, that 2% target has not been achieved. So it's running very low, which is why bond yields in the US are running so low. So it's good to have that little bit of inflation. Now, so that's the risk, but it's actually also good for equities. And we're looking at both things. There are other things also that we should look at. We're not done and dusted with COVID. The recent surge of COVID cases in Europe and the US tells us that the virus is still not nailed, and there is no reason for us to get complacent about it. And we should not get complacent about it in India as well. I mean, of course, active cases are down 50%. The daily cases are down 50% from the top, actually more than 50%. But the fact is, we are entering the winter months, especially in North India. Temperatures will fall a lot. We're entering into a period where there are more festivals, so people are going to gather around. There's anyway a lot of fatigue with staying at home, so people have started moving around. And the third thing is that pollution is coming back because economic activity is picking up. And pollution tends to hamper the functioning of the lungs, which is precisely where the virus goes and attacks. So I'm not willing to call, victory on the virus. And I think you should keep that as a risk factor as well. And in fact, if the political dynamics in the US plays out such that policy response slows down or is lagged or is a reaction function rather than an anticipatory function, then that creates a bit of risk in the stock markets. So there are, of course, risks on the horizon. No market. In fact, market is full of uncertainties, and that's the nature of markets. So we keep those risks around and we keep focusing on them. And whenever stocks overdo things in the short run, you bring those risks to the fore and take a back seat and wait for shares to correct. But the undertone is that again, borrowing Mike Wilson's phrases, we are committed bulls. And you have to buy these corrections because there's a lot more to go in this cycle before we are done. Growth will go a lot higher, and nominal growth will go a lot higher. Let me rephrase that, which is great for corporate earnings and which is very good for equities before all this is done and dusted.
Now, pardon me for not remembering the date, Ridham, but one of the conversations that we did in the last maybe 2 years, I had asked you about whether you think that the earnings are setting up the stage for growth, and you had mentioned this line that I remember. You said earnings may not be conducive, but prices are, because the markets have corrected then. Are you happily surprised with the earnings performance, and do you reckon that India for the first time might actually be surprising on the upside, and that's also a bit of a pillar for the market performance?
No, ultimately they will have to deliver earnings, right? Otherwise, this will prove to be a fake head, and markets will sell off like they have recurringly done so over the past few years. We've had many fierce rallies and big ones, and then they have not been followed with fundamentals. So fundamentals have to come back. At any point in time, the market is looking forward. It's a forward-looking animal, as we know. It's anticipating a recovery in earnings, and those earnings have to be beaten. What's priced in has to be beaten for the markets to make further headway. If those earnings don't come, then of course the market will be disappointed. Now, on your point on what's happened is, fortunately, we made a more bullish call on the economy in May when we were looking at what was happening. We didn't think that there would be a permanent destruction of demand in India. We were also anchored to our global call, which was for a V-shaped recovery around the world. And the combination meant that we were a little bit, or I would say substantially more bullish than the street. So while the street is on an average forecasting a 10% drop in GDP for F21, we are at about minus 4.7%. So to that extent, the incoming data has not surprised us as much. The element of the incoming data that has surprised me is that the labor markets are recovering faster than what I would have thought. Now, for a moment, when I reflect on this, maybe it's because this was not a plain vanilla recession. It wasn't a macro-led recession. It was a recession caused by the external agent, the virus. And as soon as the virus started fading, employment started coming back. So usually jobs is a big lagging indicator. It lags the economy by anywhere between 6 and 12 months. The economy recovers, then jobs come. Right now, it's behaving more concurrently, and I think that may be the explanation. But that's probably the surprise that we've got, not the other data. I think that's coming in line with our expectations. The earnings are also coming in quite strong, as you rightly point out. For the moment, it's largely because companies have reacted to the pandemic and cut costs. We are yet to see robust recovery in revenue growth, but I think that's in the pipeline and it will come in the next few quarters. And I do suspect that the consensus will have to lift estimates, which is a big shift from where we have been for the past few years, which is that earnings estimates have only gone down. So hopefully that turns out to be true. I've been guilty of being too optimistic on earnings for the past 4 or 5 years, and every time I've had to come and cut my earnings. So it's not like I have made some great calls on the earnings cycle, but this time it does feel like we may get a more robust recovery in earnings. And I may quickly add here that corporate India has responded very well to the pandemic. So if you look at corporate data of the last 4 or 5 months, mergers and acquisitions, restructuring, capital raising, a lot of these things are running at multi-year highs. So what companies did was use the pandemic to consolidate, to revisit businesses that are not working out, to get more focused on core areas. And that lends itself to some sort of earnings upside, which I don't think is still in the estimates or in the market. That's more important, what's priced in. So I still don't think it's priced in. So let's see how that goes. My guesstimate is, and using the earnings yield gap model that we work, the market is pricing in close to 0% growth in earnings going forward the next 12 months. And I think the number could be between 10 and 15%. So that's good. Because if I'm right, then we have considerable upside left before shares price in that type of growth. So right now the market is still not in that camp that we're going to get a big positive growth on earnings over the next 12 months.
Well, that could be a marked shift in how the market gets priced. And Ridham, before I get to some specifics, I mean, you wrote a fabulous report a few months back, 2 or 3 months back, on manufacturing, and I would want to get a sense from you on manufacturing versus services and what could do well. But just before that, one quick question. We've seen some tangible evidence of large flows, foreign flows, hitting Indian shores in the secondary market data that we publish almost every evening. Is this finally the global money getting to work into India consistently? And do you think that wall of money might stay, or is it something else? How do you decipher, in your mind, the foreign versus domestic flow impact or the evidence of that in the last 2 odd months?
So, Neeraj, to me, this looks more India-centric than EM. And my anecdotes are that people are getting more interested in India. For the first time since 2013-14, there was a huge amount of interest on the back of the taper tantrum fall that had happened in the summer of 2013, and a lot of foreign flows came in. And India did spectacularly well from September 13 right until the early part of 2015. In fact, by then, India was trading at twice the EM multiple. And then from there, we derated significantly. And at the bottom in March earlier this year, we had halved in terms of relative valuations. So there was a significant derating that India had suffered versus emerging markets. I think that interest is now coming back. So what are the factors driving it? So firstly is, of course, relative valuations. India looks a whole lot better than it has. In fact, it's near its long-term bottom. The second is we've seen some interesting policy action from the government, stuff that may boost India's long-term growth rate. If you look at the trailing 10 years GDP growth, India is running a growth rate that is well below its estimated potential growth rate. We estimate India's potential growth rate to be around 6.5–7%, and we're averaging, maybe a full percentage point below that. So now there is possibility that we go back to that trend line growth, and that I think is exciting investors, and I think that's what's pulling in the flows. The EM story is playing a minor part in this. It's, I think, a more India-centric story, and that's good news because if it's EM-centric, then it will also fade away with EM. If it's more India-centric, then I think you get more sustenance, because then it depends on what India does. And also, I think I should quickly add here that EM portfolios are running their lowest position on India since 2010, if I remember correctly. So there's not much positioning on India either. So that's a good technical factor to have in your favor.
Yeah. Some thoughts on the China plus one narrative, Ridham. I hear corporate India sing different kinds of tunes here. What is your thought? What is your understanding of how this may benefit Indian corporates? It might already be doing it. Would it continue to remain patchy and small, or could it actually balloon into something large?
No, see, I think we wrote about this, I think 4-5 months ago. It's the multipolar world that is evolving right now. So in large part, and making this very simple, we were in a bipolar world where China was the production center and US was the consumption center of the world. Because of the events that have unfolded and the trade war that has erupted between US and China, we're seeing the signs of a multipolar world getting created. A multipolar world is a great opportunity for India because multinational companies will be looking to diversify production away from China into other places. And India is a natural place for them to go to. Hitherto, it was not happening because of various constraints. India has lacked adequate infrastructure to be a viable destination for exporting. Labor laws were a problem. Land acquisition was a problem. And overall, the bureaucratic hurdles to setting up greenfield plants used to frighten multinational companies. So the nature of FDI in India over the last 5-6 years, and we've had a FDI boom, so let's not understate that, has been largely to buy existing businesses. Because multinational companies definitely want footprint in India. If for nothing, the consumption that India offers, the opportunity that India offers as a marketplace. And the way they were doing it was buying existing businesses, so they don't have to deal with the system to set up greenfield plants. So that was the way in which FDI was happening. I see a shift now coming because of a accumulation of several factors. So the overarching multipolar theme, as multinationals start to look to diversify, and mind you, they will only diversify incrementally. It is going to be very difficult to move lock, stock, and barrel out of China. You can't do that because the size of China is massive. But incrementally, you can say that India is a place that I want to set up manufacturing. Now that's being backed by some big changes that the government has done on its side, which is labor laws, this land bank thing that they are doing, and the manufacturing incentive schemes. So when you add all that up, I think we have the prospects of fresh investments. And then, of course, let's not forget, last September we had a big rate cut for corporate taxes, especially for new investments. India is more competitive than it has ever been. I dare say the most competitive place in this part of the world in terms of taxes. So when you add all this up, I think what we can see in the coming few years is manufacturing investments that we have not had. And I know earlier you mentioned about the manufacturing note. This is exactly what the manufacturing note is about. It is all it's all hooked up to these changes that are happening in the world, and we think these are fairly sustainable changes. And this may surprise investors on the upside as to how much investment India can get in the manufacturing sector with real production facilities getting set up, greenfield capex taking place over the next 3-4 years.
So, Ridham, how does an equity investor benefit out of this? I mean, because services companies are actually singing a very fine tune currently. Your report suggests that it would be a decade of manufacturing, and please correct me if I'm misquoting you, but I think I'm not. Do you think an equity investor benefits relatively disproportionately out of making a larger investment in select manufacturing-led themes, or could services dominate, BFSI, IT, what have you?
So, Neeraj, there are many facets to this. Firstly, the investment cycle that can come will boost overall growth. So all boats will be lifted. So what India needs is higher headline growth. Higher headline growth means better consumption, better investments, better profits. Okay. Now, how that higher headline growth comes is not that important. Of course, you can position portfolios to reflect the beneficiaries directly, but just the fact that India could run higher growth rates is, I think, sufficient for portfolios. So that's one. Second is that services, to the extent that they are domestic facing, I think will do very well as a consequence of higher growth. So there is no let up to that. To the extent that they are external facing, they may underperform, because if India's growth rate does revert to its trend line, then the likelihood is that services which are being exported out of the country may not grow as much. So they may underperform. And the third thing that I will quickly add here is, let's not forget agriculture in the mix. So, let's step back a bit. Over the last 30 years, we've had big underperformance from industry and agriculture relative to services. So services has gained share in GDP, and manufacturing and agriculture have lost share. These are the two places where we have seen reforms over the last few months. And these are the two places where I think growth accelerates relative to services. So it's quite plausible over the next 10 years that services loses share in the economy, because manufacturing and agriculture have to regain some of their lost share. Not back to where they were in 1990 or 1995, but at least somewhere in the middle, right? So to that extent, services loses some share. Though this is a very tough thing to envisage and to imagine, because when GDP growth goes up, the services economy will be very buoyant. But there may be a period when it actually loses share, only to regain it after that. So I think this is how I would think about the setup. And how this informs portfolios is that you need to be domestic, you need to be cyclically oriented, and that's how I think money can be made. Therefore, we are underweight exporters and we are overweight domestic cyclicals. Now, domestic cyclicals can either be consumer cyclicals or they can be industrial cyclicals. We like both. But that's how I would say would be the big picture orientation of an equity portfolio.
Okay. Last couple of questions, and then I'll end with a health question, Ridham. I've now realized that I can't not do that with you. But first, what's that big call? You've over the last 5-6 years that we've spoken, you have at times given calls which the street probably didn't quite believe in. IT, I think 4 or 5 years ago, when I was in a different place, and you and one of your colleagues called it out very well as being the space that could do very well, whether the others were underweight, etc. So what's your big call wherein you might be anti-consensus, say?
So I think the big call is that financials has lost its market leadership. And that's the sector that has done very well over the last 7 years. I think it's poised to do very well over the next few months, because it's derated significantly since March, April. But I don't think it will lead the market. The leadership is moving. It's probably moving into discretionary consumption and industrials. And I'm thinking about beaten up sectors or subsectors of the last 10 years. And I think those are the sectors that may assume leadership. And some of the big outperformers of the last 10 years may lose their leadership over the next few years. So I think that's the big call. And this will require a major shift in anchoring, because we're all anchored to, including myself, we're all anchored to the outperformers of the last few years. Momentum is a wonderful thing. It always works. Only it stops working when it does. And you get those big inflection points in momentum once in a while. And I think we may be at that inflection point going into 2021, where there is a big shift in sector performance. So let's see if this call works out. But I think the outperformers of the past 10 years are going to give up to the underperformers, and we'll see new sector leadership in the coming years.
Okay. The last question on the markets front or the equities front and investing front, Ridham. Last year, same time, you had spoken about how there is, or last year, one of the 2 years, you had spoken about how the broader market underperformance was completely neglected over a 10-year period. Maybe the broader markets had not done anything per se and had just come back to the same levels. Do you reckon that we are starting to see a shift in the fundamental performance of the non-nifty, non-large cap names? And could that be recognized by the market, and could there be a bigger alpha there?
Absolutely, Neeraj. If you are a believer in a broadening economic cycle as I am, then it goes without saying that the broad market will outperform the narrow market. The interesting thing is that concentration is at peak levels, which is the share of the market cap, total market cap of Sensex companies, and the share of profits of Sensex companies in total profits. Both these numbers are running well over 50%, and it's a mean reverting variable. So when it hits that peak, then the next thing is it starts going down, and I think it just made the peak, and we're at the start of a cycle where they will lose share in the overall market, and that means the broad market outperforms the Sensex. So I think mid and small cap stocks will do very well in the coming 2 years. The 2-year bear market, or 2.5 year, maybe longer actually, is over, and we should be looking at those stocks.
Okay. Nothing's more important than health, Ridham. Leave us with something that the last 6 months have taught you. Anything about health, any tip, any advice, even multiple ones are okay.
This may sound very grim, but it's not. But I think there's a wonderful book, and I've not read the full book. I've only read a third of it. But the title itself is enticing. It's titled Preparing for Death, and it's by the illustrious Mr. Arun Shourie. And going by what I've read, I think this is a very promising book. I think we have to all prepare for death, and I think that's the biggest learning of the last 6 months. Maybe this book, will culminate that learning into some serious points, but I think that's what I'm doing right now.
Okay, we will take that. Maybe some other time, end of the year, or otherwise, we'll talk about some eating habits as well, Ridham, because I know you're a fitness fanatic, so would love to have those too.
Let me quickly add to that, Neeraj. It's not. I'm not the expert, but it's not very complicated. I think simple living, simple food, moving the body around. The body is designed to move. It's not designed to sit in one place. It's not designed to sleep all day. And whatever those movements are, not overdoing it, not following an extreme regime, either side, whether with food or with sleep or with exercise, I think works very well. And that's the discipline you need to bring in. And that's, what this book is also about. But ultimately, that's the secret of health, as I have learned it, is just, to be moderate on all fronts and not to do extreme stuff on either side.
That could be financial advice too. But Ridham Desai, I take a moment to thank you for joining in today. And as I said at the start of the show, wish you and yours a very happy Diwali and Saal Mubarak.
Same to you, Neeraj. And you've been a very good friend all these years. I wish you all the best. And also to your viewers, wish you a very happy Diwali and a wonderful time ahead. Thank you.
Thank you, Ridham. Stay safe. And viewers, to all of you, stay safe, happy Diwali, and wish you a very happy, prosperous new year. Saal Mubarak.